Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Earnest. You ready? Let's dive in.
Welcome to another episode of Swimming with Allocators. This is a special episode. This is our best of season 3 episode. This is a 2-part series, and I just want to welcome everyone. Merry Christmas. Happy Hanukkah, happy Merry Kwanzaa, happy Festivus for the rest of us, all those Seinfeld heads out there. But I just want to, first and foremost, say thanks to everyone for listening and supporting us, whether you're an allocator, whether you're an emerging manager, whether you're an established manager, whether you're just a person interested in venture capital, and the people who fund venture capitalists. Thank you. If you told me in 2023 that this would be going on and that we have 85 episodes and now a best of episode, I would be like, you're crazy. But here we are. And I'm really excited to share. We have a top 5 list to share segments of some of our most popular episodes this year. And we had a very, 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 very technical way in which we came up with the top 5 episodes. Actually, it was more like venture math, but we took the tallies from all the downloads of our audio listeners, as well as those who watch us on YouTube, and we came up with why the valuation is $100 million. Joking. With our top 5 lists and an honorable mention. So we'll first start off with this first part 1 is our honorable mention, and then we'll count down to our 4th best episode, or our 4th most popular episode this year. And so we'll start with our honorable mention. So the first segment and episode will features our honorable mention, and it's from a conversation I really enjoyed with Joshua Berkowitz. And, you know, this segment that we feature really it really captures why this was a special episode. Josh and his family office come from having experience operating in the real estate world, a world that I know pretty well. And he really talks about the effort that goes into developing your venture portfolio, because it's so different than anything else. And in the clip that we feature, you know, I ask him why he describes his venture portfolio as a mess, and why it's an intentional mess. So I would love for you all to just enjoy one of my favorite conversations this year, featuring Joshua Berkowitz. You know, in our prep call, you spoke about your portfolio being a mess by design. Can you share what that means and why you embrace it?
I just think it's a lot more fun to call it a mess than it is to call it diversified.
Or opportunistic.
Or opportunistic, sure. Yeah, whatever the professionals like to use to describe the same thing, right? Like, what is a mess? A mess just means diversified. It means opportunistic. It means I want to invest in the things that I think will make money. Mm-hmm. Not paying much attention to what vertical, geography, stage, sort of like silly classification you want to, or box you want to put a manager in. Like, the most important thing the most important dialogue running in the back of my head when I meet a GP is, are they going to make money? Right? Like, that's ultimately why I'm doing this. Make money by helping, fund great companies that will hopefully matter to the world. There's so many ways to make money in venture. So many, from going super early stage, super late stage, to international, to domestic, to everything in between. doing funky secondaries, doing weird employee buybacks. Like, you name the strategy, I've been pitched it and heard it, and I think some make sense and some don't. If I was worried about, like, I need to go find a deep tech manager based in Austin and a health tech investor based in San Diego and a pharma manager based in Boston, that would just tie my hands behind my back and stop me from asking the most important question. Do I think this strategy makes sense? Do I think this person is amazing? Do I think they're going to make a lot of money? And so as a result of, like, turning off the like box checking exercise, you end up with a bunch of really differentiated funds that are actually pretty different from one another. So I do think they're diversified. They're just not diversified across, like, the traditional metrics that traditional asset managers or wealth managers or whatever would sort of try to diversify you against, right? Like, the classic is like stage, geography, sector. And, like, I don't think about which, do I have all the sectors covered? I just think about, all my GP's awesome.
And that was our episode with Josh Berkowitz. I love that conversation. And that's just a snippet of the insights that he provided. So I suggest you all to go back to that episode and take a full listen, because he reminds us that family offices don't need to conform or to conventional diversification metrics to have strong returns. It brings it back to just conviction. And so you'll see that if you go down to the, listen to the entire episode. And so with that, on to our next episode, which actually starts off our top 5 list. And our 5th most popular episode features Raudline and Kevin, who, this was an interesting episode and even how it's set up. Kevin had experience as an allocator in the past and now is on the GP side. And Raudline comes from the asset allocator space, looking at all types of asset classes, and traditionally hasn't done much venture. And so we had a lovely conversation with them. And in the excerpts that I'm going to that you're going to listen to back to back, we first listened to Kevin wrestle with how to prove the value of your proprietary network, and both like what he does now and what he saw people did best when he was in the allocator seat. And then Raudline follows up with a call to intentionality when connecting networks that typically don't intersect, which has kind of been a theme this entire year on the podcast, as well as conversations I have, is that how can we have more people be these connectors? I like to say, how can the 1990s and 2000s code switching kids during their grade school, how can they rise up to actually make these connections as our world becomes more and more siloed? And then the second clip is one in which they continue to talk about network effects and how in venture it's not just about access, but again, this theme of like, how do you build bridges, even if it involves embracing uncomfortable rooms. And so enjoy these 2 clips and enjoy just a snippet of our 5th most popular episode in season 3 of Swimming with Allocators. A lot of people who've been on this show or that are talking to in private, who've been in the business for a long time, there isn't going to be like a succinct, like right down the fairway answer. But that should give people like hope too. It gives me inspiration too. It's like, okay, I need to be the best Earnest that I can be and show that I can out Earnest everybody.
Mm-hmm.
I can out Earnest. I think I might borrow that. I want to add a comment though about network, not in the VC context, but just in general, because I think one of the things I realize is that we all live in these networks that don't necessarily intersect. And one of the things I'm doing in this phase of life is deliberately trying to connect networks that don't intersect, right? I have a series of networks that I'm a part of that are not necessarily related, and trying to intersect them and bridge them is one of the things that I'm intentional about. And at this point, when people say to me, may I introduce you to? The answer is always yes, because there are so many, if Kevin's point about you can only have meaningful relationships with 100 people, imagine then how many real networks exist out there. And you realize that in particular when you're talking about diversity, and you'll have people say, I don't know where to find the talent. And in my experience is I'm surrounded by the talent. Why can't you find it? Right? It's because their particular ecosystem and my ecosystem are separate. And I realize that sometimes we have to function as the role, as the connector, as the bridge. And it means learning. It means being sometimes in places where it's uncomfortable because it's not your networks. But, this was my experience, for example, working at Albright Stonebridge, which is a completely different animal than all of the chapters. That is a national security, diplomacy, global network of people who I have access to that there's nothing natural about me being in that particular network if I hadn't made that move to connect with people who are not just strictly finance. And I think to the extent there's anybody early in their career listening to this podcast, I think one of the pieces of advice I'd be is try to be intentional about cultivating your networks, because at the end of the day, that's going to be key to everything in your professional life.
Absolutely.
And Ernest, can I say one thing that I'd be remiss if I didn't say this about the network thing. That doesn't mean you can sit back and make excuses, because I know there are a lot of people on both sides and of all ethnicities and backgrounds that make excuses like, I don't have a network, I don't know these people. Now, I will say, and it's for both Raudline and I'm not trying to speak for Raudline, but I would assume.
How dare you?
Right? But I know for myself, in order to build the network, like I had to force myself into situations and put myself in a lot of very uncomfortable situations.
Yeah.
And if you're not willing to do that, your network is never going to grow.
Yeah.
And I think that's a really important point to say, especially in this climate that we're in right now, that at some point you have to just own up to it and embrace the discomfort. If you're willing to do that and just ask people out to coffee and ask people for advice and humble yourself and really try to push yourself in the rooms, that's how it works. If you're willing to do that, then that network effect can get stronger. What ends up happening is the larger, more established names end up soaking up all the capital and venture. And that's what happened in 2024. 70% of all the capital that was raised went to 30 different firms. And when you think about that, there's no way that talent is distributed among 30 different VC firms in the business. That logically doesn't make any sense. But it's not an issue with those firms, it's an issue with how the industry is structured. You need more people in the middle to distribute it.
I think that this is a great question, right? So if I take it from a perspective, I think you're right, Kevin? I think managers and GPs don't understand in general the resource constraints, on the part of allocators that may lead to check the box thinking, continued capital to the biggest players. You know, when you have billions of dollars to move, it's difficult for you to focus your limited resources on writing a $10 million check, right?
Yeah.
And, you know, those are structural issues that won't get addressed immediately. But I would say two things for LPs. The one is there are knee-jerk negative reactions to things like fund of funds. I think because of what happened in the GFC, where on the hedge fund side, where no one was protected from Madoff and fund of funds didn't do the work that they claimed that they were doing. And that, I think, has infected the entire ecosystem in a way that's been detrimental. And so I think, one, LPs rethinking that negative knee-jerk reaction. Yes, there's an extra layer of fees, but that's because you don't have the resources to field the team to do this. And yet we all know that there's a world of opportunity outside of the 30 major venture funds that Kevin was just bringing up. I don't think this is just a venture issue. I think this is true systematically. So that would be one. Rethink this negative knee-jerk extra layer fees. I'm not paying for it. Sometimes you actually should pay for it because you are not equipped to actually execute on the smaller end of almost any market you're in, where there's typically a lot of opportunity. I think the second thing I would say LPs need to do differently is they need to widen their aperture a little bit. Yes, it's true that you don't get criticized if, you know, one of the oligarchy firms loses you money. But there's a lot more opportunity than what's safe and convenient. And challenge yourself to think a little bit differently than you have historically, period.
Yeah. That's amazing advice. And I think it definitely needs to be, you know, people need to widen their perspectives, as you mentioned, because there's true alpha out there and an opportunity. Kind of changing gears, Kevin, where do you, I assume I know that your answer, but want to know some details behind it. What trends do you see in venture capital in 2025 and beyond? And, you know, are you overly optimistic or bearish on it over this next decade?
The future of venture capital, to me, isn't an industry, like a technology that's going to change everything. I think the future of venture capital is a wider representation of talent and founders that are in the market that are going to bring new ideas and new applications to technologies that need to be applied in different markets and in different ways. And I was listening to a podcast of a guy who said that he was talking about this in the cruise industry and very random cruise industry, but the reason why certain of those cruises go really, really well is because of the diversity of staff that they have on board, and the net NPS scores for people are really, really high, and things are just going really, really well. But it had a lot to do with who was on the ship. So I think if the VC industry is a ship, who's coming onto the ship is what's going to make that better. And I think technology is what's pushing that forward and making it, we'll see that in 10 years be a totally different landscape, hopefully.
I hope you enjoyed those clips of Kevin and Raudline. It was a great conversation, and I really admire what both are doing, both from the allocator seat and GP seat. And, you know, the critique of capital concentration and a call for more middle market allocators should resonate with anyone who's frustrated by what's going on and the status quo and how capital has been flowing over the last couple of years. If that resonates with you, you should listen to the whole episode. If you want to get any insights on your approach to relationships and diligence of GPs, you should listen to this episode as well. Our fourth most downloaded episode is another gem. And last episode of this part one of our two-part series, but this episode featured Jason Howard. And when I think back to that conversation and the interview itself, the words that come back to me are intentionality. I'm someone who tries to be very intentional in all the things that I do and how I'm thinking about things long term and in the short term. And Jason exemplifies that. And his story of building new Catalyst strategic partners and how he's used time and experience from, household brand names before launching this platform that provides capital and operating support for next generation private equity, growth equity managers. And so we have two clips. One that he describes the archetype of the type of manager he looks for, and explains why they lean a little bit more to buyout and growth while looking to the future in the future experiment with venture. And then he also gives a fantastic explanation and kind of primer on what GP seeding is and what both founders of firms should be thinking about, as well as any allocator that's looking to get into this aspect of the business. So with that, I want you to enjoy a snippet of all the insights from our episode featuring Jason Howard.
And in the case of some of these Fund 4 or Fund 5s, where they're looking to launch new strategies, can you give us some examples of what are some of those trends you're seeing? Which strategies are looking more interesting today?
We have a number of people who may have built an existing platform where, let's say they're in the buyout space and there's an opportunity to build a strategy. Maybe their strategy has scaled up and there's an opportunity to create a new strategy at a lower entry point in terms of company size, et cetera. Mm-hmm. So same type of strategy, same areas where they're seeing deal flow, but their current fund is just too large to pursue those types of opportunities. So that's an area that can be interesting for us. We're also seeing opportunities where managers say, hey, we're doing this in this area, but there are adjacencies to what we're doing that tend to make sense for creating a special product to pursue those types of opportunities. So you could have a manager who's doing lots of opportunities in the buyout space, but then there's an opportunity that's adjacent to that feels a little bit more like infrastructure. But there are commonalities in terms of what is consistent and when that manager is pursuing and their original strategy. We're looking for those natural linkages, but we can also see opportunities like that. The typical one that people often talk about is, hey, I have a firm, I want to launch a credit platform to pursue opportunities in that same industry. I'm sure there'll be opportunities for those in the future as well, but that's a key topic for people in the industry. Those are the types of opportunities that we're seeing.
In all private markets, we've seen a lot more competition, which I think has also created more complexity for even allocators. How do you approach that more competition and trying to find true alpha with respect to any asset class? Because we have a lot of allocators that are also listening in, and they're always looking for kind of like what are the best and brightest thinking.
Yeah, so you're right. There's been a proliferation of choice for LPs. And in that environment, particularly when you combine that with slower distributions in terms of capital coming back to LPs and you also combine that with some of the externalities that are impacting many LPs in terms of their organizations, their decision making, what their capital needs are in the future. That can be really hard. And so what it's leading, I think, a lot of LPs to do is monitor situations for longer where they may have committed faster historically. And they're also thinking more about which are the relationships that are truly differentiated and potentially upscaling and increasing the quality of the managers that they have within their portfolio. So that's what we're seeing. Do I have a magic bullet in terms of like success for a recommendation for allocators? No, but I think what allocators are doing today is figuring out where do they really believe they've received performance historically, then going down more deeply, looking at the managers and saying, hey, was this manager in an industry where essentially the rising tide lifted all boats? And was there real differentiation for this manager? So you could start to do analysis on how did this manager perform, not relative to the overall benchmarks, but relative to the benchmarks of managers who had their strategy. Did they outperform relative to those strategies? Also, it's very typical for LPs to really focus in on how managers generated their returns. Was that more for margin expansion or for multiple expansion or debt pay down? Otherwise, really focusing in on how managers generated their returns is super important, and then stepping back and saying where we are today with the team that they have today, because by the way, sometimes the people who created that performance in the past are no longer at those firms. But based on where the managers are today, is it likely to that performance is likely to persist? That's what we're really focusing on, and we think other LPs are doing the same.
I'd love to circle back to the conversation about GP seeding and what's so valuable about that first partnership, that first check.
Many GPs are historically what we found is LP capital alone isn't always sufficient to help a manager scale. And what I think GPs are looking for is there an opportunity to de-risk their fund raised, particularly in this marketplace? Is there a desire, is there an ability to help provide working capital, to provide staying power, to withstand the 18 to 24 plus months that it takes to raise a capital and build a team and start doing deals and pay the fees and costs on deals, particularly if deals don't consummate? Having the capital to be able to do that is critical. And so that's what GPs are looking for, but they're also looking for a real strategic partner who can be a thoughtful advisor for them as they are building. So sometimes there are questions that GPs had. They don't necessarily want to go to the LPAC because their ideas aren't yet formulated, or they're just trying to brainstorm. And a lot of times GPs feel like once they go to the LPAC, it needs to be buttoned up, ready to go, etc. And oftentimes GPs are looking for someone who can help in that way. So that's one of the areas that we really want to lean into and be supportive of GPs and help as they're thinking through opportunities. And to be honest, I've worked with many managers who are now managing multiple $1 billion of capital, and the success wasn't always linear. Doesn't look like that externally, but I know that based on a number of the situations that came up and the things that the managers had to deal with, but that's okay. And being able to have a partner that you can speak to and can help navigate or can help give advice on how other managers have dealt with situations that were the same, more serious, less serious, etc., I think can be helpful in the marketplace today. Again, going back to the gaps that we want to fill in the marketplace, that's what we really want to do. And a lot of times, LP business models are not typically set up to do that for managers.
Yeah.
And that's not a negative on LPs. LPs are busy. They have a focus on deploying capital in a way that's efficient and monitoring those investment opportunities. What we're looking to bring to the marketplace is something a little different, which is working and advising these managers in a more active way to help them as they're building and scaling these firms.
What are some specifics that go into that being a strategic partner? I know you and from your experience, you've seen a lot of different managers in a lot of different spaces, but what are kind of the three things you always want to make sure that you offer managers you're partnering with?
Well, it honestly depends on where a manager is on their maturity. What first-time funds may seek is oftentimes different from what a Fund 3 or Fund 4 may seek. The Fund 1, they may have more of a focus on operational infrastructure and getting that set up, and identifying great talent to attract to the team, or LP introductions, or helping them think through how to position their initial product in the right way. Those are the types of pain points that we commonly saw working with GPs. When a manager gets to Fund 2, 3, 4, at that point, they're having a different conversation, which is, again, do I need help launching a new strategy where I see opportunities, but they just don't have enough time to go and develop that idea more fully? Is it they need to reposition their LP base because a lot of their LPs were emerging manager LPs and they may not continue with them going forward? Are they trying to figure out succession at that point? Because succession and transition ownership to the next generation, and is that something where we can be helpful? Those are the types of things that arise at various points on the maturity for a manager, and we want to be thoughtful and figure out ways to be helpful to managers at each stage of the process.
And you've shared with us the benefits of seeding for the GPs.
Mm-hmm.
If you're an LP, I'm curious, what are the benefits of having somebody doing some seeding on your behalf?
Yeah, so it's a great point, and I think having seeding as a part of a LP's portfolio can provide attractive complement to other parts of the portfolio. I think the key opportunity is if you are seeding a manager, it has the potential of doing two things. One, it has the potential of providing some downside mitigation, because in addition to the LP return, you'll receive some type of economics in the manager that can help buttress whatever the return is. And so on the downside, that can be a positive and an additive to an LP's portfolio. On the upside, also, if a manager is successful and you also have some economics in the manager, that can also provide some upside performance relative to whatever the base return is from that underlying LP commitment. And so there's a potential opportunity for generating alpha for doing the same thing that many LPs do anyway, which is make LP commitments. But the requirement for doing this is being able to write large checks, being able to be early, being able to have resources to support managers. And those are the things that I think are critical. One of the things, as in terms of advice, I would give for GPs who are considering this is identify partners who they really believe can provide more than capital. Because there are a lot of providers out there, good sources of capital that are mostly financial in some ways. And that can be a fit for some GPs, but other GPs may look for something different. So that's where, again, we think that we're bringing something to the marketplace that's additive. And by the way, there are a number of great firms that are doing amazing work in seeding. We appreciate that. Because when you have smart investors and when you have well-regarded firms seeing the same opportunity and going after it, that helps to validate the market need. And the other thing I think, and you all see this a lot in venture, I think that there's a real opportunity to partner together with other seeders who are doing really great and innovative things, because that hopefully is better for the GP. Yeah. In that sense, the GP gets the same thing that a great founder gets when they have a great company and 2, 3, 4 great venture firms surround them with ideas and network and thoughtfulness about building businesses and product market fit, et cetera. That's the same opportunity that we see. when great seeders work together and help to come alongside a manager and help them build something special.
Thanks to Jason and the time he took. That brings us to the halfway mark of our year-end countdown of top 5 most downloaded and popular episodes of season 3 of Swimming with Allocators. Today we got to go back and listen to Joshua Berkowitz on being optimistic yet disciplined, from Raudline and Kevin on building and distributing networks. And you just heard from Jason Howard on what makes a next generation fund manager stand out. In our next episode, we'll reveal our top 3. That's top 3 episodes from so many good episodes of Swim with Allocators. And so looking forward to sharing it with you with those before the new year or during the new year. And I would be remiss if I didn't take some time and provide some thank yous. So thank you to my co-host, Alexa Benz, for doing an amazing job with questions, and she does a lot of the logistics of the podcast as well. To our production team, Johnny and team at Herd Media, which is like quiet as it's kept, building a strong presence in this very weird niche of technology and venture capital. And our partners this year, Tosh and Jeremy at SVB, and Shane and the rest of the team at Sitley. Thanks so much for all your support, your amazing expert analysis and interviews that we did throughout the season. And we wouldn't be here without you all. So, and last but not least, our audience. Thank you for attending our Dining with Allocators. Thank you for listening to the show. And if you missed any episodes, the ones we featured, or just that you've missed in the past, go back. They're up there. And it's evergreen learning there. So with that, hope everybody has a happy holiday season. And looking forward to sharing our top 3 episodes in part 2 of Best of Swim with Allocators.
See you later, alligator.
After Portfolio Tile, Investing with a Smile.